Hello and welcome to this session in which we will keep working with the unified transfer tax. In this session specifically, we're going to be discussing the present and the future interest gift, complete and incomplete gift. The transfer tax apply to gifts, but we have to learn a little bit more about gifts. What is considered a gift? Is it present gift or is it a future gift? Is it a complete gift? Is it an incomplete gift? Why? Because determining of what type of gift are we dealing with, it might be subject to taxes or it might be excluded. Also in this session, we would look at few examples for the gift tax and the unified transfer tax to see how it all fits using numbers. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. In the context of estate planning and taxation, gifts can be categorized into two types: present interest gift and future interest gift. Present interest in property means that the recipient, the donee, remember the person that gives the gift is the donor. The donee, the person that's receiving it, has an immediate right to use it, possess it, or enjoy it. What does that mean? It means they can do whatever they want to do with it. It becomes their property. This type of interest qualify for the annual exclusion. Now, why do you want it to be a present gift? Because when you give a gift, let's assume $100,000. If that gift is considered present interest, it means you can deduct the limit, whatever that annual exclusion is, happens to be $17,000 for that particular year. Why? Because you want to reduce your taxable amount for gift purposes. So if someone wants to reduce their taxable estate, they choose to give gifts as present interest to take advantage of the annual exclusion. So what could be examples of some present interest gift? Can you think of any? Yes, if I gave you something, anything, and that's it. I gave up the right to receive it, to take it back, then that's present interest gift. If you gave someone cash or property, these are straightforward transfer where the recipient can immediately use the cash or property. Again, there's no side deal where they have to give you anything back. Trust income interest with mandatory or annual frequent distribution. You created a trust where you put assets in there, but what you wanted to do is the income to be distributed to the beneficiary. The trust is set up where the benny is entitled to receive income at least annually. We have something called life estate. This is an arrangement where someone has the right to use the property during their lifetime, but they don't own it themselves. In other words, they can use it for whatever reason, but they don't own it. Well, if they can use it, if they can enjoy it, that's a present gift. Estate for a term certain. This refers to an interest in an asset for a specific period. That's also, if it's for a specific period, you can enjoy it. Well, you can enjoy it for that period. Bonds or notes, even though the interest on these financial statements, it's paid at maturity, they are considered present interest as the ownership of the bond or the note is immediate. So let's assume your rich uncle has a bond for GE, General Electric, and this bond is worth $1 million. But GE is going to pay the bond 10 years from now. 10 years they will pay this $1 million. But they gave you the bond. Well, you're not going to get the money now. You're going to get 10 years from now. That doesn't matter. That's a present interest. Unrestricted transfer of life insurance policies. It's when you set a beneficiary, someone to receive the fund in case of your death from a life insurance policy, and it's unrestricted. Unrestricted means that's it. It means you cannot change that. This involves transferring the ownership of a life insurance policy without any restriction. You cannot put demands on them. So if you can say, well, I'm gonna give you my life insurance policy as long as you do something. Well, you can change it. You are restricting it. As long as you graduate from college, as long as you married someone that I like or something like that, it's restricted. So it has to be unrestricted. So if it's restricted, it has conditions, right? And this is what we talk about, the future interest. The future interest is a gift that is the donee will only have the right to use or enjoy at a future date, or upon a certain condition being met. So it's either you don't have any access to it now, you cannot enjoy it, or you have to meet a certain condition, then you can use it. Examples include trust, where the donee can only access the asset upon reaching a certain age. That's a future interest. Now, future interests, this is what we need to know, do not qualify for the annual exclusion, meaning what? They are subject to the gift tax regardless of the amount. They don't allow you to deduct that $17,000 per donee for the annual exclusion. Therefore, the donor often needs to file gift tax return for these type of gifts. What are some examples of future gift? Something called revisions. What does that mean? This occurs when someone gifts an asset but retain the right to reclaim it at a later point. It's like lending you something with the intention of taking it back. Use the asset until I need it back. Well, it's not really. You didn't really give a gift, because you can take it back and you want it back. They're using it now, but you can take it anytime back. It's like lending something. Remainder. These are interests in an estate that become effective in the future after another interest has terminated. For example, a parent could set up a trust where one child received income for life estate, and another child received the remainder after the first child's death. Well, this is a remainder interest. Trust income with mandatory accumulation. What does that mean? It means income may be required to be accumulated over time and not distributed until a specified future date or event. Remember, when it's a present, it means you have to give distribution every year. Here, it's mandatory accumulation, and you don't distribute anything until a future event. For example, that future event could be graduation from college, or you have to study a certain major until I give you the money, or you have to attend a specific university. There's some sort of a condition. Present interest without ascertainable value. These are gifts that technically provide a present benefit, but their value cannot be readily determinable. This can make it difficult to classify for tax purposes. For example, I would allow you to use my yacht, but how much is that worth if I have a luxury yacht? Also, gift can be classified as complete or incomplete. We need to talk about those. What is a complete gift? In the context of gift tax, a complete gift is the one where the donor has relinquished all control and interest in the property, making it fully and irrevocably to the recipient. Simply put, I gave it to you, you can do anything with it. That's basically what complete gift. I have no control over this. Now we have to understand, you could have a complete gift for not yet born a child. A gift can be deemed complete even if the donee is not yet born, provided there's a mechanism in place to ascertain their identity later. This is common in estate planning where future beneficiaries like unborn grandchildren are included. That's fine, that's a complete gift, although you don't have a person. Also, potential reversion to donor. Even if there's a clause allowing the property to revert back to the donor under certain conditions, the gift can still be considered complete. This is because the initial transfer, when you transfer it initially, it's fully and irrevocably shifts control and rights away from the donor to the donee, unless a condition is met. Now, what would be an example of this? Just to make sure it's not, they're not putting any restriction. You can use it now, but there's a condition. If something happened, you have to give it back. Emma transferred a piece of real estate to her son, David, with the clause that the property will revert back to her if David sells or leases it within 10 years. So David can enjoy it for 10 years for any purpose except selling it or leasing it. That's a complete gift. Despite this clause, this revision clause, the gift is considered complete for tax purposes because Emma has irrevocably transferred control and rights of the property except for a specific sale or a lease condition. This transfer is treated as a complete gift subject to the applicable gift rules at the time of the transfer. Now, why do we need to learn about complete and incomplete? Again, the distinction is important for tax purposes. Only complete gifts are subject to the gift tax regulation and they would qualify for the annual gift tax exclusion. This means the donor might have to file gift tax return and potentially pay gift tax if it's incomplete. Incomplete gift, a gift labeled as incomplete and therefore not subject to the gift tax. It's either conditional or revocable. What's conditional? These are gifts that are contingent upon the fulfillment of a specific condition. Remember David, right? His name is David, right? In this example, David can access the property, but there's a condition it will go back to his mom in case something happened. Here it's different. You don't get it until something else happened. Until these conditions are met, the gift is not considered complete. So don't confuse the two. For instance, a parent promising a car to their child only if they graduate from college is a conditional gift. So the gift is not complete until that child graduates. Or revocable gifts, in case the donor maintains control over the gift by retaining the right to revoke it or change the terms or the bennies. Here, the classic example is life insurance, where you can put a beneficiary, but if you can also change that beneficiary, then it's not a complete gift because you can change it anytime. So the gift becomes complete only when the donor relinquishes the right under circumstances other than their death. If they die and they have it, it's done. But if they are still alive and they can change the donor, they can change the beneficiary, the person that's going to get the life insurance, they didn't really give a gift. It's incomplete because they can change it anytime. Such a gift becomes complete and taxable only when the donor's right to revoke or change it ceases for reason other than their death. It means they would say, that's it, this is your benny and I can't change it anymore. For recipient, gifts are not taxable income and no gift tax is owed by them. Remember that. We mentioned this in the prior session, but recipients don't have to worry about this. Let's take a look at a few examples. A father promises his daughter that he will transfer $50,000 into her account if she completes her master's degree. This promise is a conditional gift. Until she graduates, the gift remains incomplete and not subject to the gift tax. If she completes her degree, the gift becomes complete and the father may then have to consider gift tax implication. The daughter, however, will not owe any money on that $50,000 because it's gifted to her. Now, how to calculate the gift tax? Well, first what you do is you add up the total value of all gifts given by the donor during the calendar year. This includes both cash and non-cash items. Then you have to deduct the exclusion. Subtract the applicable annual exclusion amount per recipient. Remember, each recipient you can deduct an amount happens to be how much? $17,000 if we're dealing with 2023. Now, if you're looking at this recording in future years, this amount will change. The exclusion amount will change. For married couple, they can split their gift and they will have an exclusion of $34,000. For non-cash gifts such as property or stocks, the value is used as the fair market value of the gift at the time of the transfer, not the cost to the donor. Let's take a look at this example. Michael Thompson, a single taxpayer, made the following gift in 2023. $30,000 cash to his brother David, an antique watch valued at $10,000 to his friend Sarah, 200 shares of Blue Sky Technology stock valued at $200 per share to his cousin Greg. And Michael made no other gift during the year. That's it. So let's list each gift and its value. $30,000, $10,000, $40,000, which is 200 shares times $200. So the total gift value is $80,000. How do we determine if the taxable amount? Well, we're going to take the amount for David, then deduct, because this is a complete gift, present and complete gift. This is what we're assuming. What's left for David is $13,000. For Sarah, 10,000 minus 17. Well, really, whatever Michael gave to Sarah, there are no tax consequences because it's below the limit. And for Greg, the gift is for 40,000. They can exclude 17. What's left is 23. Now we calculate the total taxable gift, and if the math is right, that should be 36,000. Now again, do we have to pay taxes on this? And the answer is most likely not, because not most likely, as long as Michael did not make any taxable gift in prior years up to 12,920,000 minus 36,000, Michael will be in good shape. But now he's starting to count his gifts toward that 12,920,000. So up to this point, so even if you complete, let's assume they do complete, when you complete how much you have to pay, then there's a credit. The credit will wipe out your taxes because there's a credit. So as a single taxpayer, total taxable gift for the year amount to 36. This is calculated by subtracting the 17,000 annual exclusion. Remember, if you are dealing with couples and they decided to do the gift split, what's going to happen is rather than 17,000 here, you're gonna have the marital, and it's for 2023 is double 34,000. Just make sure you're aware of that. Be careful about that. Let's take a look at another example. Mark is single, made the following gift totaling 130,000 during the year. 30,000 to the endowment fund of State University, a qualified nonprofit institution. 30,000 directly to the State University for his nephew's Alex tuition. $30,000 to his nephew Alex for his off-campus housing expense. 20,000 to the regional hospital for his colleague Sarah's medical treatment. $20,000 to his colleague Sarah to help her recovery expense at home. Compute the amount of Mark's taxable gift for the current year. Let's go through this. The $30,000 is for a qualified nonprofit institution. This is a charity. What does that mean? Boom, it's out. It's not counted. It's basically excluded. Remember what we looked at the prior session. Charities, you don't, for qualified charities, you can give as many as you want. 30,000 directly to the State University for his nephew Alex tuition. Also, this is not subject to any gift tax. Why? Because it's paid directly to the university. 30,000 to his nephew Alex for his off-campus housing expense. Off-campus housing expense. Here we're talking about this is a gift, and what's going to happen? It's going to be 30,000 minus the annual exclusion of 17. 20,000 to the regional hospital for his colleague Sarah's medical treatment. It's paid directly to the hospital. Again, out. Once you pay directly to the hospital, out. Then he paid $20,000 to Sarah to help her with her recovery. Well, that's generous of him, but that $20,000 is subject to the gift tax. So 20,000 minus 17, whatever is left, this is the taxable amount. And if we perform the computation, what's going to happen is this. It's going to be 13,000 left from Alex's housing and 3,000 for Sarah's recovery. So all in all, Mark will have to start to add up his gift tax, and it's 16,000, and he's going to be counting toward the 12,920,000. So again, if he pays taxes on this one, he computes his taxes, there's going to be a credit that's going to wipe it out, whatever it is, because it's still less than 12,920 in total. So let's take a look at the cumulative lifetime gift. How do we compute this? This is important. So here's what we do. First, we look at the gross gift in a calendar year at fair market value. This is the total value of all gifts given of a calendar year measured at their fair market value. Then you would exclude the amount per donee per year. Then you will take out that exclusion, whatever happens to be per year, per person. Remember, for 2023, we're dealing with a 17,000, but this is per person. So if you gave 10 different people, then it's 10 times 17. This is the annual exclusion. What's left is left. Then you take out any unlimited marital deduction for gifts to donor spouse. Again, remember we talked about the marital deduction in the prior session. Marital deduction, whatever you include here in marital deduction, you will deduct this. Gift to spouse are typically exempt from, subject to certain conditions and limits. We talked about this in the prior session. Minus any charitable gifts. Any charitable gifts are also deducted. So you start, let's assume, maybe using numbers is better. Let's assume we started with $2 million. This is the total gross gift we gave for this particular year. The exclusions happen to be, for the sake of simplicity, 170,000, because we gave 10 different people. Of that 2 million, we gave $1 million to our spouse. Okay, then we deduct this, and we gave $100,000 to charities. $100,000 to charities. Gift to qualifying charities are exempt. Now, this is equal to the taxable gift this year. So 2 million minus $1 million is $1 million, minus $1 million minus 270, 1 million minus 270,000. What we're left with is 270,000 is 730,000. So notice this individual started with 2 million after they took out the exclusion, the marital deduction, and the charitable contribution. They end up with 730. This is the gift this year. Now what we do is we add to them gifts from prior years, because remember, this is cumulative. So the prior year is whatever we computed in step 5. Let's assume for the simplicity in step 5 we didn't have anything in prior years. This is the first year we give gifts. That's great. Then this is the cumulative lifetime gift, which is $730,000. For example, this individual right now, they're far away from the $2,920,000 limit. So they only so far they're subject to $730,000. Now let's compute the taxes for the sake of illustration. So from the prior slide, we said $730,000 were the cumulative for this individual. Now we're going to compute the tax, and for simplicity, I'm going to say the taxes on this, it's 20%, just for simplicity. Although I'm going to do an actual example showing you how to compute the taxes on this, just for the sake of simplicity. Let me pull my calculator here and take 730,000 times 20%. So the taxes is 146,000. Now what's going to happen is this. We're going to deduct any gift tax paid on prior gifts, if any. We're going to assume 0, because remember we said this individual never computed any taxes. Then we can deduct $5,113,800. Now, where did this number coming from? This is a credit. How is that credit computed? This credit is computed as if, remember we have $12,920,000. If we have to pay taxes on this amount, the taxes on this amount will end up to be $5,113,800. Let me see the percentage, just gonna give you a percentage amount. $5,113,800 divided by 12,920. One more zero. So it's approximately 39.58%. So what does that mean? It means that first 12,920,000, if you had to pay taxes on them, you would have paid $5,113,018. So the rate is almost 40%. But since the government gives you this credit, so what's going to happen is this. So you remember, you computed your taxes at 146. Well, this $5,113,800 will wipe it out. But again, once it wiped out, $5,113,800 minus 146. It means for future years you have left in the credit $4,967,800 because you used 146. And again, same thing as saying of the 12,920,000, you're getting close to it. You already used 730,000. Saying the same thing because I just want you to know what's this number. This is the credit. Again, these numbers might change in 2024, 2025. Nevertheless, it's the same. So this individual, what's their gift tax? 0. Let's take a look at another example where we have actual numbers. Let's take a look at this example. Assume Bob has made $13 million in cumulative taxable gift over his lifetime, including the current year gift. What does that tell you? It means if in this year they exceeds the 12,920,000, it means this year Bob will have some tax consequences. He has previously paid 0 in gift tax. So because why? Because it seems in the prior years he was below 12,920,000, but this year he went over this amount. The lifetime exclusion for 2023 is how much? 12,920,000. So if he had to pay taxes on the first 12,920,000, he would have to pay $5,113,800. What did the government says? The government says, yeah, this is the credit against, the first 12,920,000. So the total cumulative lifetime gift is 30 million. If we take out the amount excluded, what's left is 80,000. Here we go. This year and going forward, anytime Bob makes a gift above the annual exclusion per person, above 17,000, guess what? Bob will be taxed. And the amount is how much? 80,000 this year. How much taxes will he have to pay? The tax will be 18,200. Now, how did I come up with this 18,200? We're going to go back to this table, the unified transfer tax rate. And this is, you would read it just like you would read the individual income tax rate schedule. For example, not over 10,000, 18%. Over 10,000, but not over 20,000 is 1,800, which is the first 10,000 plus 20% of the amount over 10,000. In Bob's situation, Bob is at 80,000. So Bob is right here in this bracket. 80, but not over 100,000. What is the taxes? The taxes are 18,200 plus 28% of the amount above 80,000. He's exactly at 80,000. Therefore, the tax is how much? 18,200. And this is how we figure out the tax amount, 18,200. What should you do now? You want to go to Farhat lectures, look at MCQs, additional exercises, additional lectures. That's going to help you Prepare for the CPA exam, enrolled agent, accounting classes, any professional certification you are taking. Invest in yourself. Good luck, study hard, and of course, stay safe.